Good afternoon, everybody, and welcome back. We continue today with our Closing Bell webinar series. Now, for those of you that do not know me, my name is Josh Levitan. I am one of Fausto's day trading instructors here with CTU. Let me get a quick sound check first so I know everybody can hear us loud and clear. All right, it's great to see everybody, and like I had said, welcome back. So today we are continuing our Closing Bell webinar series with not just a guest, but one of our personal friends here, a great guest with us today, Todd Gordon, founder of TradingAnalysis.com. So, Todd, what he'll be talking with you guys today is exactly the name of his topic, is the death of the market. Is the punch-drunk liquidity party over? So, to give you some insight on who Todd is, well, Todd not only is the founder and CEO of TradingAnalysis.com, but he began his trading career back in 2001 trading the equities market, so he is a seasoned veteran of the market, not just with equities, but he also specializes in currency and commodity markets as well. So a few of our students in our trading room, the Cyber Group, we're big fans of gold, and specifically trading ETFs with Nugget, Dust, and Todd will go over exactly what you need to understand in terms of the gold market itself, alongside other markets and sectors, but in terms of how to trade the currencies and commodities and equities all to it. All right, so Todd, are you there? Hey, give me one moment here. Just want to make sure that Todd's audio is on right now. Volume a bit low, he says. Let's see.
Sound is okay.
There you go, Todd. You're loud and clear right now, Todd. You're good to go.
Okay. If you guys want me to up the volume here a little bit, I can. Very low. Josh's zone's loud, they say. Well, let me hear. Let me turn up the mix a little bit, and see if this helps. How about, oh God, now I'm peaking. I'm full on peaking. Is this too loud now? Sweet Caroline. Okay, perfect. I was about to start singing. All right. So let's go, guys. We'll have some fun. Crazy day today. Did you guys see kind of the core theme of what was happening here in the markets? Like one of the biggest sector rotations that we've seen in a long time. I mean, tech was getting wrecked, and industrials, financials are just bid. I mean, it's crazy what's going on in here, and it's kind of like the indexes are almost caught. Like financials are going insane with Trump coming in, and big rotation out of growth stocks into more value like industrials, like financials and stuff like that. So yeah, it's been pretty wild. So we'll I'm coming out of my head spinning. I was trading all day, just going crazy. So that always turns out to be a scattered presentation. So if that's okay, just kind of bear with me. But obviously we're coming into interesting times, and as the Chinese say, may you live in interesting times. So all right, let me just share my screen. Yes. Oh, I gotta install this thing. Trump effect, that's for sure. Stay with me. I gotta install my screen sharing thing. Oh, please don't tell me. This is a brand new Falcon computer, and I haven't presented on installation complete. Yes. Launch. Application. Monitor number 4. And allow. And okay, perfect. I think it's working. Yeah, Dave, I don't know if you saw my YouTube video. I tried to go to Mac. I've got like a 4-monitor system on Mac. I tried that for like 8 months and I gave up. I called Falcon Trading Computers back, and Scott, my buddy over there, was like, please build me a cool PC, and he just sent it to me, so I'm back on PC. I do all my YouTube videos and stuff like that on Apple, but trading, you got to go on Mac, or you got to go on PC. Especially doing presentations like this, it's much better. Anyway, let's get to the point. At some point, guys, this liquidity party is going to be over, and we're starting to see bits of it. Those long-term bonds are getting hammered here, and that's causing some serious sector rotation right now. Whether it's the Fed, the market's starting to front run the Fed, or it could be foreign central banks who are selling these bonds like China, spiking our interest rates because they're very afraid of policies, international trade policies Trump might undertake. Whatever the reason, these longer term rates are moving up, and there's a lot of stuff that's happening here. So volatility's back. All right. When it's going to crash, we'll talk about that. But the good news is for guys like you, and I've known Fausto for probably a decade now, and we're all traders, and we live and breathe for volatility. And that's when a trader makes most of his profits, is in the volatile periods. That was one of the first things I learned when I first started trading when I was 21, is you're going to make between 70 and 80% of your profits during 20 to 30% of the time. And in my experience trading, it's always been in those volatile periods. So I'm psyched for volatility. Hope it stays. And I mean, it looks like it's here. We're getting some really nice movement in here. All right. As always, we're going to be talking about some live trading stuff here. Don't trade with money you can't afford to lose, because you will be scared money, and you will hold on to your losers too long. You will cut your losers too short. You'll never see your trade plan through to completion. You got to trade small enough so you're confident enough to accept the risk and just trade through. Like I said, I'm a trader. That's all I've ever done in my career is trade, and it's a boxing match. You never go for the knockout punch unless it's laid out there for you on a platter. You always go for the decision at the end of 12 rounds. You probably get knocked down a couple times, but you got to get back up. This is not a get-rich-quick scheme. This is for people who like to work hard and really enjoy trading, and that's the only kind of people I like to work with. So there will be a major correction coming up. Exactly when, I'll give you an idea of when I think it might happen, but nobody knows for sure. The point of the presentation is, when this comes, are you going to be prepared or unprepared? For those who are prepared, as I said, volatility equates to opportunity as a trader. If you're unprepared, it's going to feel like a crash, and you're going to get blindsided. So if you guys don't know me, I am Todd Gordon. Josh gave me a nice introduction there, and I run tradinganalysis.com. I first started equity day trading when I was 22, actually, in San Diego. I went to a CTA, Trading Markets, trading publishing company. They also ran a CTA. I got promoted up to the CTA in the hedge fund, moved back east, went to Wall Street with Gain Capital, Forex.com. I was their senior tech analyst, traded on the hedge fund. I kind of made my name be known because what I would do is write a research report every single day for our customers around the world, and then just simply execute that one trade in the hedge fund, and then I'd come back and report how we did, what we did right, what we did wrong. It was all about transparency. I've always traded and done my research and trade recommendations exactly the way I trade. So that's how I built my career. Met my wife in 2008, not 7, in Hoboken, where I was living in New Jersey, and I knew I was going to marry her. These are our two munchkins, Jake and Brody, and knew I wanted to be around to watch them grow up. So I left Wall Street life, and now I run my business out of my home office in New Jersey. Gotta show this picture. Those of you who've been in a presentation probably seen it before, but you've got to include it. And the only funny addition I have here is this is my best man, Jeff, and he's doing the best man speech, and he is completely wrecking me in front of Trump. And Trump and Melania are there in the audience, and I'm just looking at Trump as Jeff is talking about all the bad stuff him and I have done over the years, and Trump is just like shaking his head like, oh my God, who is this guy? So we had a wedding reception at his place in Bedminster, New Jersey. So it was kind of fun. He said he knew me from CNBC, but whatever. He just happened to be there at his club, and that's where he's doing all his planning and stuff for his upcoming presidency. So we're only about 20 minutes away. So that's why we had it there. He was a gentleman. It was fun to hang out with him. You guys may have seen me on CNBC. I've been doing it for about 9 years now. I've been on almost every show that they have, and they usually call on me for the technicals. Now I run the home business, tradinganalysis.com from home. So that's me. And I think one of the things that, a lot of the kind of the cause for the volatility and the massive shift that we're seeing is this growing wealth gap and income inequality. You know, the rich are getting so much richer and the poor are getting poor, and the middle class is just being taken away. And I'm a firm believer that this process is a result of the Fed and the central bank and the government meddling in, you know, our day-to-day lives and meddling in the free trading markets too much. You know, by artificially pressing interest rates low, they've created a whole dynamic and a whole shift that's really pushed the middle class out. And that's causing a lot of discontent. And we're seeing so many protests and riots and, you know, fighting amongst ourselves. And it's really done no good for us. And this is not a political presentation at all. Trust me. I'm just trying to tell you where the source of the volatility is coming, not to being mentioned taxed to death. Exactly right. So that's this, you know, make no mistake, this tension and this volatility that we're seeing is I firmly believe a result of the policies of current administration. And listen, the unwinding of that is creating volatility, and that's great. That's what we want as traders. I don't care what is really happening. Of course, I care from a social point of view, but from a trading point of view, I want vol. So just to give you a little history, you know, they dropped interest rates to combat the credit crisis that started at the 2006 top. So they started dropping rates to this ZIRP policy, zero interest rate policy. And what they did is they took trillions of taxpayer dollars and they started buying the bonds. And basically what the Fed did was take, you know, our taxpayer dollars, fund their Thinkorswim or, you know, cyber trading account and just start buying the hell out of bonds. So they bought, you know, mortgage bonds, they bought US Treasury bonds, and what they're trying to do is drive the yields on those bonds down. So they're trying to get the price of the 10-year bond as high as possible in the other bonds, because you'll notice that the interest rate or the yield moves perfectly and inversely against the price of the bond. And I know a lot of you know this, but some of you don't. And it's kind of a concept that people get a little confused, and it's important to understand this whole relationship between bonds and bond yields and why the stock market's kind of going crazy right now. And not only stock market, but commodities and the currencies and stuff like that. A lot of it has to do with what this bond market is doing. So the Fed, you know, they took our taxpayer dollars and just created credit out of thin air to buy up the bonds to drive the yields down, because what they're trying to do is lower the borrowing costs across the country to get you to borrow more money, to buy real estate, to buy new toys, and to stimulate the economy. By stimulating the economy, they were fighting off deflation, which is falling prices, which was a result of the credit crisis. So the Fed, what the bankers are trying to do, again, is increase the size of their BS balance sheet, which means get more and more bonds on their balance sheet, which would propel the S&P, and that makes the central bankers happy. Okay? That's the long end. Those are the 10s and 30-year treasuries. At the short term, they slashed interest rates. As soon as the credit crisis occurred, they slashed the Fed funds rate from 5% all the way down to 0, and here it stays. Just put this in perspective, guys. We went from 5 to 0 in like 2 years. It's now 2000 and almost 17, so 8 years, and they've managed 1/4 point interest rate increase. I mean, that's crazy. Like, we're like, actually, excuse me, 2. We're up to 50 to 75, 2. So the interest rate is like right here right now. The Fed funds rate's right here, and there's so much battle about when it's not only going to go to here, but also up to here to 1%. It's taken 8, and it'll probably take 10 years to get up to this level. And look how far it fell in the same 10-year period. So that's just how significant this move is right now. So if you want to kind of follow where that federal funds rate's going, watch the 2-year treasury. Okay, this is the rate or the yield on the 2-year treasuries, which correlates very closely to your federal funds rate, which is where the Fed meets every month and decides whether to want to raise it or lower it. Whatever happened to save for a rainy day? Yep, saving is frowned upon these days. You got that right. Echoing, yeah, I don't know what's going on. I have like Howard Stern quality microphone and studio and mixer and stuff. Like I don't know. I have the feeling something to do with the software, because I use this on GoToMeeting every day and record the videos, and it's like spot on. So I kind of have fun with technology a little bit. So I apologize for if it's not great sound, but we're going to push on. So I keep talking about there's low volatility, and low rates equals low volatility. So basically, they're pushing. The Fed is trying to push rates as low as possible, which forces people into the stock market. And as stock prices go higher, volatility generally goes lower. And unless you're a buy and hold investor, if you're trying to trade it, it makes for a pretty difficult environment. So not only are they trying to boost stock markets, they're trying to push up real estate, consumer spending, and get corporate investment in the form of hiring workers and building out infrastructure. So when they were pitching this whole bond buying quantitative easing thing to us, they told us it would prevent a market meltdown, generate some inflation, which would stop deflation. Inflation is increasing prices, deflation is falling prices. Increase the velocity of money, which is basically the borrowing and lending of money, just the pace of movement of money around the economy, which is what you want. Make it easier for you and I to get loans, as well as companies to get loans. And the hopes were those companies would take cheap loans and hire more people and build out more infrastructure. What actually happened was, they told us it would prevent a market meltdown, and the stock market tripled in 7 years. I mean, amazing. PE ratios started to move up. Valuations started to get a little rich as the stock market started to move up. We still struggle with our goals of a 2% inflation. And that's been the big thing. And that's what we're trying to fight off is we need to get some increasing price levels. And that's going to be the sign that the economy is coming back. We still don't have that. We're still well away from our 2% inflation goal. So all this bond buying, $4 trillion worth of bond buying, still can't give us a consistent 2% inflation reading. Loans are still difficult to get for less than premium borrowers. And as I mentioned, the companies, rather than borrow money and investing, back in hiring people and building out, more factories, they played financial games such as share buybacks, mergers and acquisitions, and that just basically boosted their share price, which made them look good in front of the board and made themselves rich. So that's what actually happened. So it was designed to be good for banks, corporations, and consumers. And it's my opinion that, by the Fed just forcing the stock market up, and this is generally viewed as a Democratic, as opposed to Republican policy, that, they're saying they're trying to help everybody, by doing these bond purchases, keeping interest rates very low, where really all it does is benefit the people who have excess capital to be invested in the stock market, which, as we know, is not a lot of people these days. Wealth is way down. So really all it does is benefit the top, 5%, 2%, 1%. It hurts the middle class as the wealth gap is increased with increasing costs but falling wages. Fixed income savers, my parents and other people who rely on bonds, and my dad is fully in the stock market because he's like, why not? We're making money. My dad's crazy. I'm more risk adverse. I do this for a living now than he is. He's like, you can't make any money in bonds. And I'm like, oh my God, Dad, I hope this doesn't end badly. So that's completely counter to how the Democrats tried to sell this to us. Okay, they said it's good for everybody, and in reality, it's not. So this is just a chart to show you that the yields going down will push volatility down, and that was the whole purpose of what the Fed did. Trump and many others argue that the Fed is politically motivated to keep Democrats in office by keeping equity vol low, stocks higher, Obama's approval rating high, and HRC into office. That was the idea. A lot of people kind of got after him, and trust me, I'm not getting political here. I'm just giving you the facts of why we're having volatility right now. But global equity strategist Morgan Stanley came out and said the following, Ruchir Sharma. And this is really, really interesting. I want you guys to pay attention to this. Since the Fed began aggressive monetary easing, which is cutting rates in 2008, nearly 60% of the stock market gains have come on days once every 6 weeks where the Fed meets. In other words, of the 700 total points that the S&P has gained since the low, 422 came on those Fed days. So the 700 points that have been a result of the Fed's bond buying, quantitative easing, and lowering of interest rates, of the 700 points, 422 of those come from days of the Fed when they announced no change in rates and more bond buying. The average gain on Fed days was 0.5%, or 50 times bigger than the average gain of 0.01% on all their days. So like 60% of the gains came on Fed days in the stock market. So that just shows you this is a Fed-driven market. Stock market is no longer a barometer of the economy, but rather Fed policy. Towards the end here, stocks have lost the uptrend, but what really have started to get overvalued towards the end was the staples. And if you guys notice, who's the weakest days? Okay, here's today's hit list. Staples are getting rocked lately, and they didn't even have such a bad day. Technology had a bad day, but real estate, utilities, and staples, all interest rate sensitive, those are the sectors that have been getting really rocked lately, and it's because of this reversal in this bond trend that we're talking about right now. So if I asked you guys, everybody please get your keyboard out. How many of you, or what would you say the 35-year relationship of stocks and bonds are? Do stocks trade with bonds, or do they trade against bonds over the last 35 years? And I want to see some text in there. Do stocks and bonds trade together or inverse? And I want to see some answers in there. Inverse, with on an average, previously against, now with against, with, inverse correlation, inverse fairly close, against, inverted, mostly together, inverse together, with. Okay. All right. Boy, that's pretty evenly split. And this is crazy. Well, check this chart out. Okay. So this is stocks and bonds over since 1979, where I was born, right there. So this is, I know this is a 37, almost 38-year chart. So the S&P is in red, and the bonds, 30-year bond price is in blue. So on the whole, these things are positively correlated through the 70s, 80s, 90s, up to the 2000 top. Stocks and bonds had a strong positive correlation. They dipped below zero down into a strong negative correlation, stocks up, bonds down, inverse, in two distinct times. 2003, low of the stock market, and 2010, low. So this was the tech crash, this was the housing crash. So there's only two periods where stocks and bonds over the last 37, 38 years where they really trade inverse, and that's when the stock market falls off. So you can actually say that the bond market on the whole is pretty positively correlated to the stock market. So if the stock market were to sell off again, does that mean bonds are going to rally again, like we've seen in the last two crashes? I don't know. Because take a look at this 30-year, this is the 30-year bond on a 3-month, this is a quarterly chart. Look how overbought this bond market is using a simple regression channel. This is the Fed buying bonds with taxpayer dollars. It's not been this overbought in 4 decades. So if the stock market were to sell off, I don't know if the bond market can really continue this massive rally that it's seen, because again, I think foreign central banks in foreign countries are afraid of a Trump administration. They're starting to sell our bonds. I mean, we know China's in there selling bonds because they're already pissed off at Trump. So if the correlation holds, will we see stocks and bonds fall together, which means stocks would sell off with increasing interest rates? And if that's the case, guys, we're going to see massive volatility. If you see the stock market sell off and bonds maintain their bid and bonds go back, where's my chart? Bonds just kind of sell off a bit, but then just keep going, then okay, we'll be all right. It'll be a typical bear market. But if stocks and bonds sell off together, that's going to be real volatility, because that's going to be falling stocks with increasing interest rates. That could be like Japan. We could be in for 20, 30 years of just, not even stagflation, but falling price levels, maybe even deflation. That's going to result in falling stock prices. So I don't know. I don't know what's going to happen. I'm not smart enough to figure it out, but I just want to be prepared, like a day trade or like a swing trade, even longer term. I want to be prepared in either situation. So when we get there, we're prepared. We have an idea where our game plan will be. Yeah, I grabbed the gold, probably. I actually just bought a lot of Bitcoin too. That's going to be part of my presentation. I have a lot of BTC as that. So if Hillary won, Yellen was hired, rates lower for longer, stocks and bonds higher. We'll worry about the debt later. Who cares about 20 trillion in debt? We'll figure that out later. Everybody loves us, right? If Trump won, they said Yellen fired, rates higher, stocks lower, begin working off the debt soon. So, we'll see. Yellen is still there. I kind of thought she would resign on the first day, but who knows? Maybe Trump winds up being more moderate than he campaigned on. We'll see. But he certainly is in favor of higher rates, and we're getting higher rates. We're seeing those bonds sell off pretty sharply, whether it's by choice from reflecting Fed policy or it's China dumping our bonds ahead of a Trump administration. We don't know, but pretty big move down. And this is the 30-year bond. Rates are starting to go up. We're about to buy a new house. I should have locked in about 30 days ago because my payment went up 0.75 of a point here in the last month and a half. So I'm kind of looking to get this thing done. Okay, so that's kind of, and again, guys, just to put this in perspective, I'm a trader. Like, I swing trade options one week to the next. This is just a presentation how I handle my longer term money and what I'm gonna do longer term. Like, I have a trading account. I trade super actively. I probably traded 10 times today. Like, just to give you an idea, this is longer term. Okay, check this out. This is super fun too. This is the dollar on a quarterly chart, 3-month chart. So the dollar has been dropping, as interest rates have been dropping just because, bond price has been up for 35 years, which means bond yields have been down for 35 years, which means the dollar generally follows bond yields. So the dollar's been falling for a long time, 40 years. But there's been 2 distinct rally phases in the dollar. This one lasted 25 bars, which is 25 quarters, which wound up being 2,250 days. So I think that's like 6 years, maybe, right? 6 by 4. Yeah, 6 years. You'll notice that once the consolidation broke here and we broke into trend, this guy lasted another 25 bars, another 6 years. So obviously we have a precedent of a dollar time frame in terms of rallying being 6 years. Now, I'm going to argue that the consolidation, which was right here, this was the credit crisis, this was the housing crisis and the European crisis, debt crisis. It was mostly a lot of volatility, but sideways, and then we just broke into a range a couple years ago. If you do another 6-year or 25 bar projection, that's going to give you a target of November 2020, which is the next presidential election. So, that's kind of cool. I mean, maybe the dollar's going to rally up until the next election. Now, if you want to argue and say that the uptrend actually began here, okay, I can certainly see that. If that's the case, 6 years forward from this low puts you at December 2017. So either way, the dollar should rally through the end of this year and into next year. So that's one of my favorite trades is the dollar. We've obviously broken downtrend resistance, now holding the support. So it looks like the dollar should continue to move higher. Dollar typically has an inverse relationship with the S&P. Right now, they're trying on this direct relationship for feel. But on the whole, the dollar and the S&P trade inverse. So if the dollar is going to rally another 20%, that might be a problem for stocks. Okay, and I just kind of jumped ahead, but here is the dollar and the S&P. So the dollar, same chart, and the black and white bars is the dollar, blue is the S&P. And there was a key intermarket shift that occurred in the late 90s. So the dollar and the S&P trade together. Everybody wanted a piece of the NASDAQ bubble here. Everyone's rushing into the US to buy tech stocks. That crashed. S&P sold off. Sorry. S&P blue, dollar here. So crashed. The Fed started doing all kinds of crazy stuff. The housing bubble propelled the S&P up. Credit crisis, and the S&P came back. But what you'll notice is right around the 1998 level, there's 2 key events that happened that caused the shift in the S&P and the dollar. I won't go into it just in the interest of time, but real quick, it's the Asian currency crisis and long-term capital management, which brought in disinflation, deflation. Don't need to understand it. all you need to know for now is the S&P and the Dow and the dollar have gone into an inverse relationship since 1998. So if the dollar is going to rally for the next couple of years, the S&P, based on this inverse relationship, might start to sell off. As I told you, yeah, BH, good question. If you don't have Forex or futures, how do you trade the dollar? Just there's all kinds of ETFs you can trade. I have dollar positions everywhere. Let's see. I have FXE. So I have a bunch of short FXE positions, which are your euro. If you're short the euro, you're long the dollar. I have this UUP on here. I'm short puts in the UUP, which is a long position in the dollar. You can just trade it in the ETFs. Yep. So as I said, we're going to sell this house, and we're going to move into something else. I have an office basement down here, and I have no windows down here, and I'm starting to go a little crazy. So we're going to move into something with a walkout basement, windows, and so I can kind of save my sanity. I'll show you my office. I just took a picture to do it, throw it on YouTube. So this is where I'm standing right now. I've got this new stand-up desk, which is pretty fun. I'm doing the webinar right here, and this is my Apple over here where I do my YouTube, but there's no windows. And if you spend 12 hours in a windowless room, you start to feel like you're in prison, and you might start to go a little crazy. So we're moving. So my buddy in the neighborhood, he's a good real estate agent, and he made the point to me, as bond yields go up and the 30-year fixed mortgage goes up by 1%, people lose 9% of their purchasing power. So what that means is if you qualify for a $500,000 mortgage, rates go up by 1%, you can only now control $455,000 worth of leverage for buying power. So this goes back to my proposal to you that the middle class is being squeezed again, because if rates go up, the kind of guy looking for, $500,000 house isn't going to have a lot of discretionary capital to reach for more house. Like, let's say the guy at the $500,000 level, depending on where you are in the country, if you're in New Jersey and New York or something, you're going to struggle to get that third garage or that extra room at that level. So, the guy who's buying a $500,000 house doesn't have that much extra cash to reach for something greater. So he's going to have to downscale and buy something lower. So you're going to get falling price levels at that mid-level pricing. The guys who are buying multi-million-dollar houses, they can reach a little bit more. They can make up for that 9% because they've got access to capital elsewhere. So again, I think it just goes right back to that middle class just getting screwed. So again, I think that's a source of volatility. So this is IYR, the ETF on the real estate, and this is the 10-year yield. So as yields drop, more people can afford more house by borrowing, and we start to move up. So decent inverse relationship there. But as these yields, sorry, what am I doing? Oh, I skipped the chart. IYR real estate ETF S&P or yields down, inverse relationship. Here's the S&P, and I captured this chart like the week before. Actually, no, this was November 3rd. So this was the week before the election. The real estate market had already been selling off relative to the S&P. You can see there's a good correlation between the two. They're right on top of each other, they're tracking each other. But look at real estate selling off ahead of the S&P. So it's kind of making a preemptive move. And if you just kind of look around at some of the REITs, look at this. FRT rocked. HCP rocked. KIM rocked. SPG, Simon Property Group rocked. I mean, these REITs, and it's funny, like, I got a lot of friends who all know them in the business and stuff, and they're like, everyone's telling me about the 7-8% yields they're getting on REITs and how great they are. And I'm like, okay. And I was just starting to listen to this like 6 months ago, and a lot of people were saying it. And, isn't that just how the markets go? And they're probably having that conversation like right here with me. How these things are getting destroyed. So what's happening is the real estate market's starting to sell off as rates are starting to go up. Is this assuming 10% down payment requirement? I don't think that has anything to do with it, Ben, but that's not my area, so I'm not sure. He just told me, this is fact that he throws out. 1% move up in 30 year fix, you're going to lose 9% buying power. So I don't know if that. I was confused about the 1 to 9% gig. Yeah, if the 30-year fix right now is about 3.5 to 4%. So if 30-year fix goes from 4% to 5%, it goes up 1%. You know, if you could afford $1 million house, now you can afford a $991,000 house. You know what I mean? But that's, again, I'm not a real estate guy, so I mean, that was my understanding, but it made a lot of sense. So there, you know, that's this whole thing that I'm talking about, sector rotation with this big moving yields, was crazy. Look at this. Look at this today. You guys, this is, I trade on Thinkorswim, great platform. Look at the dichotomy here. This is, red is all the selling today, all in tech. Look at all the green in financials. Crazy. Like this looks like a Dow 200 point up day. And this over here looks like a Dow 200 point down day. Crazy rotation out of tech and healthcare and into financials, into industrials. Energy's been strong recently. And then consumer discretionaries come on. But major rotation coming out here. So I'm just insane. Look at this in the Russell. Look how distinct this is in the Russell 2000. Financials, industrials, hella strong today. Tech and healthcare wrecked today. Really, just really interesting stuff. So, you know, there's going to be some stocks that benefit and some that get hurt. Rising bond yields are good for the financials. If Trump is going to come in and get rid of Dodd-Frank, it's going to free up the banks to do a lot, and that's why Goldman is just through the roof. We just took profits in Wells Fargo today. We had the WFC put credit spread on. Those of you guys who trade options. Goldman's through the roof. All the insurance guys, the banks, money center banks, investment banks doing really, really well in here. Stocks that suffer. Actually did a video for CNBC on this yesterday on Kroger. We did a little earnings trade in KR. It was lower. All these stocks that are old economy stocks that pay dividends are really coming under pressure because they've been bid up strong into kind of an overbought stock market, right? And now rates are starting to move up. You can start to make some money again on bonds. So they're like, we don't want to take the individual company risk and just get the dividend from stocks. We can just move into bonds. So that's why these dividend payers are getting wrecked. REITs, we already talked about it. And there's some consumer discretionary stocks that are really underperforming with the move up in rates. Let's take a look. Lowe's and Home Depot really come under pressure. I mean, look at Lowe's, well off the highs. That's a yield and a housing story. Nike stocks big time underperformed over the last couple of months. Target, another one. Oops, I can't type. TGT, hugely underperforming what the broader market's doing. I mean, compare this to the SPY. SPY straight up. Those stocks are getting hammered. So that's kind of what's going on with this yield and staples play. So let's completely switch gears and let's talk about some trading strategies. Okay, I just kind of opened you up and showed you how I look at the markets, you know, longer term, and you know, just kind of get the flow of, you know, what sectors are moving and industry groups are moving and how to allocate, you know, money and stuff like that. But I'm still a trader, and I like to take these same strategies and start to, you know, take specific setups in the longer term intermarket flow and manage my longer term money. So completely shifting gears here. Let's talk about how, you know, I actually set up trades. And the first concept I want to talk about is a swing wave. So it's real common, basic concept. It's a high bar with a lower high to the left and a lower high to the right. Swing wave low is a low bar with a lower high left and a lower high to the right. Real simple. So here's what it looks like up close. Okay, got a high bar, lower high left, and a lower high to the right. Same thing, swing wave low, low bar, high low left, high low right. Now you can use candles, bars, doesn't really matter. Can't use closed charts. Now, this concept of swing waves, I like to begin to quantify it and say if a higher low is not exceeded in at least 5 bars before and following, it's a minor swing. If a higher low is not exceeded in 13 bars before or after, it's called a major swing. So what that means is here's the SPY, and we have a high bar here. We've got a lower high to the left and a lower high to the right. If you can count 5 bars before that do not exceed that high, and 5 bars following that does not exceed that high, this guy is painted with a purple dot, and that's called a minor swing wave high. If you have a low bar or a high bar, doesn't matter. Here's a high, a low. These are major swings that are given a blue dot. And a blue dot means that this higher low has not been exceeded 13 bars before and 13 bars following. So the charts look like, my charts look like they have blue and purple dots on them. And this is just a really quick way for you to identify the most significant turning points in the markets. And this is going to be the foundation of how I like to set up trades. I like to do a lot of kind of fixed level analysis. I like to do a lot of fib. I like to do a lot of trend and corrective analysis and just figure out where the most important swings in the market are and where I'm going to base my studies. So these are what my charts look like, and these are the blue dots here. Okay, blues are the 13 bars, and the purples are the 5 bars. Okay, so the majors are blue, and then the minors are purple. All right, so this is the concept of swing waves. One of the best ways that I like to look at the trend or how far a trend will advance is by finding, one, what the trend of the market is, but then I like to look for measured moves. And this is a concept that's rooted in fib, but it's pretty simple. If you have an ongoing trend right here, how far will this current trend last? And one of the starting points that I think you should always use for determining how far a trend will last is look at the prior trend. How do you determine where a trend starts and stops? You look for the most recent blue dot low to blue dot high in the case of an uptrending market. Just look for the most recent blue dot low to high swing. Take that distance and project it off the current swing. Okay, so if you saw a $30 move in Alibaba in the last blue dot to blue dot move, you really want to be aware of where the next $30 move will come in. You will see a lot of activity around that measured move area right there. Okay, so NDX, take a look at this. This is all of 2016 in the NASDAQ. Okay, how far will this current advance go? Well, look for the most recent blue dot to blue dot move. Okay, we're looking for the top here. So we got a blue dot to blue dot there. There's a good trend swing. And the most recent blue dot low to high I see is right here. This distance, this trend swing was almost exactly equal to this trend swing, and the NASDAQ has begun to sell off. We tried to get through it all summer into the fall, and eventually we've given it up. Take a look at XLK. This is a technology ETF. Okay, take a look at this. Okay, same thing. So the trend is up, obviously. Where are the two major trend swings? Well, there's a good trend swing here. We set back in a 3D wave correction, and there's another trend swing here. So as you're rallying up and the market just has a hard time getting through this level, you're like, all right, well, how far did the last trend go? So what you do is you go on TOS or any platform that you're looking at, and you go down to this tool right here, Fibonacci extensions. Okay, and this is a 3-click process. Excuse me. You're going to click the beginning of the prior trend first. You click the end. There's your blue dot. You click a second time, and all of a sudden this guy's attached to my cursor. All right. So you see the distance from 0 to 100%, from $37.71 to $44.44. That's exactly equal to the early 2016 rally. Check this out. This price swing was exactly equal to this price swing, and it held once, twice, 3 times, 4 times, 5 times. Guys, you can't make that up. That's not a coincidence. I guarantee you that's not a coincidence. This kind of stuff happens all the time. Even look at this little blue dot to blue dot swing. It's exact, like it doesn't happen all the time, but if you pick one trade where you're like, okay, there's the 100% right here, I'm going to try to get involved with a tight stop. I mean, that stuff is really, really valuable. So that's what we're talking about. This is a simple Fibonacci projection. It's called a measured move or a two-step pattern or something like that. You always want to be aware of where that measured move comes in. So I already jumped ahead, but symmetry or measured moves, many times the distance of a prior trend will impact the current trend. This equality point acts as resistance in an uptrend and support in a downtrend. It's just a simple Fib projection. Okay, we can use it to study trend wave to trend wave, or we can use it to study corrective wave to corrective wave. All right, so let me just show you more. I already showed you, I jumped ahead, but there's that NDX chart again, the NASDAQ. All of 2016 was a big measured move in the NASDAQ, and we're starting to sell off. Rut on the weekly. Sorry, I cut the date off, but this is 2015 into 2016 in the rut. Blue dot to blue dot swing, rally back. There's another blue dot to blue dot swing, almost caught the low of the Russell. And we tried a couple weeks to close below it. We did get one close below, but then we snapped right back above the 100%, off to the races. This is Chipotle, CMG, just a little 60-minute example. $45 move in CMG to a $45 move in CMG is the top. DLTR, little $11.50 move. This one wound up being $12.30, not quite $11.50, but we then begin to move off the lows. Bonds, check this out. I did a presentation similar to this last year, and it was actually November 17th that I captured this chart of last year. And look at the bond market, TLT, blue dot to blue dot move. Off the low of the correction, I'm saying, where could we go to the next measured move target, which wound up being $151 was the measured move target. We actually went to 144. So I wasn't long for all of it. I wish I was, but you know, TLT was at 119 bucks. I was like, guys, we could go up to 151, and we went to 144. So it was pretty close. TLT, that was a weekly. Let me just show you the chart. Oh, that's a mess. Let me show you a clean chart. Okay, so here it is. So here's your blue dot to blue dot move, set back, and I was looking for a move to 151, and we went to 144. So not really close, but still pretty good. Okay, pretty good calling a move from that low. And here we are off the lows. Now, I'm going to skip ahead because I see something that I really want to show you. You can not only compare with these measured moves, trend wave to trend wave, you can also compare corrective wave to corrective wave. Okay, so let's do the exact same thing. Let me get rid of everything off the chart. Drawing, extension. I want to compare the distance of this blue dot to blue dot correction off of this high. Look where we are right now. We are right at this 100%. In the TLT, it's 119.50. We've been shopping around here for 3 weeks now. And if you snap above at the end of this week or even next week, 119.5, you're going to know why. Okay, because this distance is exactly equal to that distance. This kind of stuff comes into play all the time. Okay, sorry I'm not answering questions here. Link to the recording, I'm not sure. Fausto, I'm sure, has got it under control. Have you tried Fib time extension of blue dots? All the time, Ben. Great question, and I do it for options expirations all the time. Very good question there. Okay. All right. So that's just some of that. So measure move. Now, if it doesn't hold, okay, if the measured move of the 100% doesn't hold, I'm going to bring some Fib to you. It doesn't mean it's a complete failure. It suggests continuation. And it also suggests continuation past 100% to Fibonacci 161%. I'll take this trade all the time. So back to TLT, if you don't hold 100% here, more times than not, you will get a continuation down to 1618. Okay? If 119 doesn't hold, decent shot we're going down to 105. And you know, if 105 trades in the bonds in TLT, you know interest rates are going to spike. And we got to see if this economy has got what it takes to hold, you know, interest rates that are significantly higher based on that move. Now, you can also do it upside down, like I just mentioned. I'll get rid of this. If TLT kept going past 100% on the top side, what I mean is if we got through 100%, 152, if we didn't hold, oh, come on. If we didn't hold 152, you were looking for the 1618 at 176. So if you don't hold 100%, decent chance you're going to get up to 176. Really good relationship that I like to trade. Okay. And I'll put option trades on there. If you get through 152, you know, like, all right, let's put on some kind of call spread, buying at the money call here, selling at the money call, out of the money call up at the 1618. Okay. So just throwing some fib at you. So I know these two concepts of the intermarket and the fundamentals I talked about is drastically different than what I'm talking about here, but I'm starting to try to set up trades with you and show you how we do this longer term. So this is XLV healthcare. And again, I captured this on November 3rd. So we're in a good downtrend. We do blue dot to blue dot back up. You're 100% tried to hold. The measure move tried to hold. We gap through, and then you're like, okay, perfect. I'm looking for the 1618 at $65.50 in the healthcare ETF. Time frame is that? That was a daily. Maximize sell. Okay. Let me just go back. Let me erase everything. Let me set this up again. I'm missing my big delivery here for you. So we're talking about from 76 down to 72. So right there, 76 to 72, blue dot to blue dot. Back up. So we didn't quite get to the 1618. We got pretty close. We got within $1 or $2, and we rallied up quite sharply. Okay, so 65.49 was the 1272, or sorry, was the 1618. Why am I off a buck there? Okay. Okay, that's a little better. 65.36, so we got very close to the 1618. So it's a good trade. If you don't hold 100%, you're going to try to target the 1618, and we fell just short of an XLV, then begin to move up. Okay, so just some kind of light fib for you. And you know, the reason I use these blue dots is a lot of people say fib is very subjective, and I don't know where to start and stop it. I really like to just pick out the most significant turning points with these blue dots, and that just kind of helps me use the tools of fib. This is the rut on the 100%. Again, I captured this November 3rd. Blue dot to blue dot in the Russell. Blue dot to blue dot. What happened at 11:53? I don't even know. Let's take a look. It's kind of fun going back a couple weeks after you do a presentation and see how you did. Let's see. So I was going off of the June to July move. Here it is, June to July in the rut, blue dot to blue dot. Oh, how you doing? I mean, are you guys kind of like blown away by this? Like, if you know where to look, it's so obvious, you know, once you get introduced to it. That was the low in the Russell. I mean, you can trade at that level. You absolutely can. Okay, this stuff happens more than you think. It's pretty wild. It is voodoo. It's fun though. Okay, let me keep going. I'll look at charts. I'm going to hit this quick, just in the interest of time. We did fib projections, and that's one of the more advanced fib studies, but retracements. Okay, this is, you probably have all heard of tried to use retracements. Here's a good relationship, all right? So if you get a good trend move up, you know, let's say it's a $10 move, you drop $5, that's a 50% retracement. If you drop $6, there's your 61% retracement. The last retracement I like to use is the 786, 78%. Okay, if you don't hold 786, the trend is over. Okay, so again, if you have a $10 move up and the market goes below 786, and just so you know, like I'm sure you've all heard of the, I bet 61.8% of you have heard of the Fibonacci 618 ratio. Just to be a math geek, the way you get 786 is you take the square root of points of 618. If you just take your calculator and hit square root of 61.8%, you'll get 786. It's pretty crazy. Square roots actually come in very handy with fib. I won't even get into that right now, but it's pretty awesome. If you don't hold 786, you are very likely to go down and test the 127% external retracement. So what that means is if you move up, you don't hold that 786 retracement, you can assume the double bottom will break and you'll get down to the 1272. Another relationship that I like to use all the time, like that measured move up to the 1618. If you don't hold 786, you're probably going down to the 1272. QQQ. Okay, blue dot. We didn't get a blue dot yet because we don't have 13 bars off the high, but we broke through 100%. Again, I captured this on November 3rd. Let's see how we did. Can we reach the 1272 at 112 in the Qs? We did. We did. Okay, so let me just set this up for you. So again, back here, I'm looking from September to October high. So there's September to October high. We did not get down to 1272. I thought we would go, and I was wrong there. And again, I'm not just setting these slides up to make myself look smarter in every single trade. I did this presentation right before the election, and I haven't touched it since. So this one did not hold, but that doesn't mean that, it didn't hold on this attempt. But if the NASDAQ continues and we break through, we still could very well be in for a test of 112. You really want to focus on that level in the NASDAQ, 112. That's going to be key. All right. Now let me just remove all drawings, and I want to do a projection for you. So there's blue dot to blue dot. Let's do a little projection right there. Blue dot to blue dot. Okay. So we're at the 618. 100% is going to be 113. That's going to be key. What about this blue dot to blue dot? Off the top. Okay, you're looking for clustering. There's two levels right there. That 113.23 is going to be key. Okay, I like to do some of this fib stuff. So to pull this together in a little bit, what I like to do is I want to know what intermarket analysis, what bonds or stocks or commodities or currencies are going to impact, the NASDAQ. And then I like to find the strong sectors and strong industry groups to be long. And if I'm bearish on the overall NASDAQ and I've got intermarket confirmation that stocks are going to go lower, I want to find the weaker sectors and industry groups to be short. Like if I'm trying to position for a move down to that fib support in the Qs, obviously I want to look in some of the tech areas that have been very weak and try to swim, downstream. So that's kind of what I'm trying to do here. That's the way I approach the markets. Now let me get back on track here. Keep pushing. XLV healthcare. If that 786 retracement breaks, looking for the 1272, and that guy should be on the way as well. XLV, we are trading at. We got down to 60. Actually, that wound up being the low. 66 was the low. So that 786 actually did hold. We bounced all the way up to 72 in XLV. So we did not break that 786. Okay, Pfizer, healthcare, testing that 786. We ultimately held. So just a little introduction to fib there. Okay, and I will definitely look at some charts. And Pamela, I have a nice little offer for you if you got blue dots and the purple dots. Yep, so no worries. It's just a plug-in. It's easy. And you could do it. It's no crazy, no secret calculation. Just makes it easier to do. Okay, let me keep going here. And I know we're up against an hour mark, so it's going to get, people are going to get bored, and I fully understand that. Let's just talk about this real quick. When you're talking about longer-term moves, right, the default settings on your charts will serve you wrong. So if you look at this Dow from the credit crisis low up to the 2015 high, and you just draw a simple trend line underneath the lows, are you still in an uptrend? And if you look at this chart, you might say, yes, no, maybe, possibly. But what you need to keep in mind is as the stock market has tripled in 7 years, looking at a 1,000-point move in the Dow today compared to a 1,000-point move in the Dow in 2009 is like comparing apples to oranges, two totally different things. Okay, and what I mean by that is let's take a look at the first move up from the 78 point from the lows here. Okay, 4,900 point move off the lows in the Dow. Okay, huge move from 6,000 to 10,000 in the Dow. 4,900 point move was 78% of the underlying. If you're looking for the next 4,900 point move, like we saw back here, a 4,900 point move up here only represents a 37% gain. Okay, so that's roughly half as significant. As you get higher in prices, similarly sized price moves are less relevant. So this is the concept of log scale, which is a setting that's available on most charting packages. If a stock goes from 100 to 120, that's a $20 move, 20%. Higher price stock goes from 150 to 180, that's a $30 move, but still a 20% move. Stock goes from 200 to 240, $40 move, still 20%. So as you get higher in price on a chart, that similar size, that same size dollar move becomes less and less significant. Okay, or said differently, you need to get bigger dollar moves to get a similar size, percent size move. So what's the point here? When you're looking at these huge moves that we've seen over the last 8 years in the stock market from the bond bubble, you want to introduce this concept of log scale because it will change everything. It will change where your trend lines come in. It'll change where your fib comes in. It changes everything. So the S&P last year on an arithmetic, this is the default setting. Here's how the trend line looked in the S&P. And you'll notice that a 200-point move in the S&P is the exact same size as a 200-point move here, right? Well, if you switch on all the major charting packages, then the charting scale is going to start to look a little weird. This is a 250-point move in the S&P. 250 points as a percent of 500 is 50%. This is a 50% move in the market. To get a same 50% move, let's say from 2000, what's 50% of 2000? 1,000. So the same distance on your computer monitor that you're looking at right now, 2,000 to 3,000, that distance right here is the same as this distance, but yet it's 5 times more points. So as you get higher, the price number, the price levels are going to get scrunched, and it's going to change the shape of the chart. Take a look at crude oil. Okay, we have an uptrend on the default chart, but if you look at the log chart, support had been broken at $70. Crude oil broke support on the log chart well before it was indicated on the arithmetic chart. Back to that S&P, we broke trendline support up around 2000 in the S&P. That's when the uptrend had been lost. Apple looks like support won't be tested on the default chart until about 80. Support had been broken way up here like 110 in Apple. IBM, default chart not till 110. On the log scale, looks like right about 140 is when the uptrend is in danger. Okay, so that's what we're talking about here in terms of looking at longer term moves and knowing when the trend is broken, right? So these are just some of the tools that I use in the longer term. I'm going to save this for another time, the above average true range, judging how overbought or how oversold. I'll save this for another time. But basically, to kind of fast forward, we're looking at these standard deviations and above average true range to figure out how overbought or how oversold the market can become. So I've kind of introduced you a little bit of how I look at the markets longer term, right? We talked about where the intermarket analysis flow comes in, where the technicals come in, how I set up my targets. We didn't get to talk about entries very much, but we like to figure out not only why a market's moving from a fundamental or an intermarket point of view, but also where it's likely to go from the technicals. The best trading, I think, on longer term is where fundamentals equal technicals. I can day trade and short-term trade with you all day long purely based on technicals, but when you're looking at longer term stuff, you got to have an idea of what's going on, and that's kind of the approach and the offer that I have for you today. Michael, yes, I use log scale on daily and above all the time, so I can use arithmetic on less than a daily chart. So I do believe there's a big volatility period coming up. and I have something laid out, very attractive offering for my friends here at CTU. Fausto's been a good friend for a long time, and I was just hanging out with him in Vegas a couple weeks ago, and we've done a lot together. So this is kind of a longer term program, how you kind of participate in longer term trends. If you're not prepared, as I mentioned, it's going to be pretty scary. If you are prepared, it's going to be very profitable, I believe, trading opportunity. As I said, this is all I've done in my career is trade, and I know that I usually make my money in the volatility periods and kind of chop around and just do whatever in the low vol periods. I like to trade vol. So I think we're coming up to a very volatile period. So it's going to be good for us and your friends and family who aren't prepared. Your job is to give them some support and shoulder to cry on when this market comes off and they're just caught long, because it just happens time and time again. So if you have the right tools, I think it's an opportunity period. So I have a course going on right now. It's recorded, it's archived. We're about to get into the meat of it. Crash or correction, top 5 tools every pattern every trader must master. So I'm going to show you everything I know about trading and excelling in the volatile markets. As I said, it's been my experience, you make between 70 to 80% of your profits during just 20 to 30% of the market year. Okay, I believe we're coming up in one of those periods. So I'll share with you my tools, techniques, preferred markets, and strategies to trade this period ahead. Here's the bonus, and this one's about to come out next week. You're going to get 3 months of my portfolio newsletter. I'm going to tell you exactly what positions I'm getting in, how I position size, entry price, stops, risk, share size, etc., etc. This one is about to come off. My first edition's about to come off. Okay, so as I mentioned, this comes along, this kind of volatility period comes along every 5 to 10 years. I think we're coming up on that period. This is for people who like to do a little bit of work. This is not the secret, keys to the kingdom, have you on your yacht with the Wolf of Wall Street. This is for people who are just trying to exploit an edge in the market. So if you want to get involved, guys, here is the offer, tradinganalysis.com/crash. Okay. TRADING analysis. This took me a while before I got this URL. ANALYSIS.com/crash. Here's what you get. The 3-hour course that actually morphed into 6 hours. I did 2 3-hour sessions recorded on November 7th, ready for you to view right now. We traded live the day after the election, and I had positions flying everywhere. I had the biggest P&L day of the year on November 9th. And I basically canceled the live trading session because what I was going to do is just say, guys, all right, here's how we're going to position our portfolio going forward on the 9th after the election. It wound up being so volatile. I was like, guys, I just need to cover some positions, book profits. Let me reschedule. So I just did the first live trading last week, and we set up some positions. You guys have access to it now. And then we're going to start releasing the portfolio newsletter, and I'll show you how I'm doing longer term. Okay, you also get the fib measured move calculator. When you're doing the log scale, when you're doing the measured moves, you're going to get a downloadable spreadsheet. You get the option strategy selection tool. You get the stop loss and stop trail plan. I'll show you how exactly I'm handling all the trade. Oh my God, the munchkins are coming down here. Guys, I'm trying to get everybody in the crash or correction course, and Jake and Brody are invading my office. I think it's time for me to get office space. You get the PAR. So I'm going to show you exactly how I position size with the position account at risk positioning tool. So you have a spreadsheet, okay, of how, and I'll show you how to use this based on your account size, based on your risk tolerance of how big or small you should trade. You get the 3 months of the portfolio news tracker, plus you get the swing wave indicator. Those are the purple and blue dots. I have them available for all the major charting packages. It'll be on the course homepage, okay, where you'll be able to download the course and download all the indicators. So it's over $1,000. Guys, we're doing it for $97, and you're good to go. You get all of that for $97, tradinganalysis.com/crash. If you guys have any questions, my team can be found at info@tradinganalysis.com. Okay, that is the offer. We will start doing the live trading was the 9th, and then we just did another one last week. That is available for you to view right away. So you get a lot of content for $100. Okay. So that's the offer. That's a look at what the log scale calculator looks like. You plug in the beginning and starting points, and it'll tell you where your log and arithmetic measured moves are. You don't need special software to do this. We're mostly trading stocks, ETFs, and some light options. You don't need to be heavy into options for this. Okay, and this is just kind of a look at some of the course. This is the art of the trade, as I mentioned, account risk and trade management. This is basically, I'm going to take you through my size tracker. So take you through all aspects of account management, which is this side, the risk management, which is your tiering. I'll show you how to figure out how large or small the position size, and then the trade size. Okay. Guys, I'm sorry, I'm being invaded, and I'm going to have to yell at my wife for this one. She knows better when I'm doing a webinar. But we have a lot to show you. So that's the offer, guys. Tradinganalysis.com/crash. Okay. I hope you guys get involved. I hope you enjoy it. And again, I would normally stay and look at markets, but my wife is giving me the eyeball. She's got an event she has to go to, and I am babysitting. And there's a kid with no shirt on walking in my office right now. All right, come here, buddy. You want to talk to the people? Yeah. All right, what do you want to say? Come here, Muscles. Come here, Muscles. Say hi, everybody. Say hi, everybody.
Hi, everybody.
Can you say crash or correction?
Crash or Bishop.
Crash or what?
Bishop, your merchant.
I don't know what you say. Oh my God, guys, I am so sorry. All right, come here, monkey. All right, can you say, Jake, can you say crash or correction?
Crash and share.
All right. So I'm trying to protect your two nest eggs in the coming crash. Hopefully you guys will take over my trading business, but you guys are not very good to do webinars with. Guys, I apologize, but I am just responsibilities of an at-home trader. I hope you guys join me. I promise during the course my munchkins were not around, and I'll leave it there. So thanks for having me, guys, and thanks to Josh and Faust and the whole team at CTU. I hope you guys take me up on it. Normally, again, I would stay and look at charts with you all day long and answer questions, but I'm on daddy duty. All right, I will. Oh my God, I gotta go. I'll see you guys later. Have a good one. Oh, monkeys.